Bill Holdings just beat Q4 2026 consensus across the board. For you tracking the headline numbers, revenue came in at $436.2 million, which topped the $430.37 million estimate. Non-GAAP EPS completely crushed it at $0.84 against the expected dealers' 70
Yeah,
cents.
that is a massive beat.
Right, and looking ahead, FY27 guidance is calling for total revenue between $1.81 billion and $1.86 billion, with EPS ranging from, well, $3.56 to $3.79. But, like, if you watch the ticker, the stock reaction was incredibly muted.
Very quiet reaction, yeah.
Yeah, shares slipped roughly 3% in regular trading before clawing back about 2% after hours to hover right around $48.70. So today on this deep dive, we are pulling from the earnings release and analyst notes to figure out why a massive 20% earnings beat barely moved the needle. I mean, are the underlying segment margins hiding something? Or is this, this massive AI pivot they're attempting just completely misunderstood by the market?
Well, to figure that out, you really have to look at the sheer velocity of their margin expansion versus the actual quality of those earnings. Because on paper, Bill's non-GAAP operating margin broke out to 23%.
Wow, 23%.
Right. I mean, that is a massive 860 basis point jump year over year. Core revenue is humming along, too. It's up 16% to $400.5 million, with transaction fees now making up 74% of total revenue.
Okay, wait, hold on. We can't just cheer a 23% adjusted margin when the actual real-world GAAP net loss just widened to $18.5 million for the quarter.
Right. The GAAP numbers paint a slightly different picture.
Yeah, I mean, are they just leaning heavily on adjusted metrics to mask the fact that they are, bleeding cash in their day-to-day operations?
So that widening GAAP loss isn't a mistake. It is actually the cost of a deliberate structural pivot. You really have to trace that $18.5 million loss directly back to the $80 million restructuring they just executed.
Oh, the restructuring. Right.
Exactly. Management is completely rewiring the company into an AI-native platform. They've already got over 175,000 businesses using their new AI agents. But more importantly, they're unifying their entire sales motion.
Meaning they're changing how the reps sell.
Yeah. Instead of selling point solutions, they are forcing the sales team to push multi-product adoption to drive up revenue per user. They are explicitly targeting a Rule of 40 exit by fiscal 2027.
Right, meaning the revenue growth rate plus their profit margin needs to hit that magic 40% threshold.
Exactly.
Well, that explains a lot, actually, because when you overhaul a sales team to focus on complex multi-product deals instead of quick single-product wins, you get immediate collateral damage in your pipeline.
Oh, absolutely.
It is like switching a restaurant from a fast food drive-through to a sit-down fine dining experience,
Yeah.
You are going to serve way fewer customers, even if the check sizes are ultimately much bigger.
That is the exact mechanism causing the turbulence we are seeing. By forcing the sales team to hunt for whales instead of scooping up minnows, the top of funnel is getting severely squeezed.
Right, I saw that.
Yeah,
Yeah.
net new customer additions absolutely plummeted this quarter to just 1,800.
hmm
And when you look at that FY27 guidance we mentioned at the top, it already bakes in a 3% growth headwind before the year even starts.
Wait, where exactly is that 3% drag coming from?
Well, 2 points of that drag are coming from expected friction in their spend and expense dynamics as they transition these customers.
Okay, and the rest.
The other point is lost revenue because they are actively retreating from their custom bank channel partnership.
Oh, I see.
Yeah, they're deliberately cutting ties with lower margin distribution channels to focus entirely on their direct, higher margin AI platform.
So they are shrinking the top of the funnel on purpose, basically, to build a highly profitable AI-driven core. But, that brings up a scenario we haven't touched on.
What's that?
If Bill successfully drives up their revenue per user and hits those massive profit margins, but their absolute customer growth stalls out, well, do they just become a prime acquisition target?
I mean, that is the million-dollar question for investors right now.
Yeah.
If you build a highly efficient, high-margin AI engine, but you can't get enough new passengers on board yourself,
Right.
a legacy fintech giant with massive distribution might just decide to buy the plane.
Exactly. Well, definitely something for you to watch closely as this AI transition plays out over the next few quarters. Be sure to follow the show for your daily earnings coverage.